you, Governor, and good afternoon to you all. This is the fifth monetary policy review for this year. So as you are aware, Central Bank reduced the policy interest rates by further 200 basis points. And the major considerations that were taken into account are the faster than expected easing of inflation and firming of inflation expectations, and the protracted subdued economic activity, and the easing of balance of payments pressures to a large extent, and the need for a faster and adequate reduction in the market lending rates, because we have already seen a significant adjustment of the risk premia after the announcement of domestic debt optimization. So this easing of monetary policy stance will help normalize the interest rate structure in the period ahead. Accordingly, the standing deposit facility rate now stands at 11%, and the standing lending facility rate now stands at 12%, and the statutory reserve ratio stands at 4%. So with June 250 basis point reduction and the current cycle's 200 basis point reduction, and also with the significant reduction of the risk premia on government securities, the market interest rates, particularly lending rates, are expected to adjust downwards adequately and swiftly in the period ahead. On the inflation front, the disinflation continues as envisaged, helping firming inflation expectations. We saw a June inflation number, 12% headline inflation, and the core inflation for the first time after a couple of years has come down below 10% level. And you can see the chart on the right. This disinflation has been supported by all major categories of inflation, including food inflation and energy inflation and other categories as well. And as you can see here on the table, if you compare September last year versus June this year, there's a significant difference in the inflation outcome. Headline inflation was 69.8%, which has come down to 12%, and core inflation was 50.2%, which has come down to 9.8%. And food inflation in particular, which was at 95%, has come down to 4.1%. Non-food inflation has come down from 57.6% to 16.2%. And in certain categories, there's negative inflation as well. Transportation sector, for instance, which had massive 150% inflation, is now recording 3.1% negative, and the other sectors as well. So we are comparing this outcome with our April quarterly projection. So this fan chart that we published in April has 3 dots. Those are the monthly inflation outcome of April, May, and June. So we have faster than expected disinflation in the last 3 months, and the average inflation, quarterly average inflation, is on the inflation horizon, forecast horizon. So this faster than expected inflation is supported by mainly falling food inflation and energy inflation. So the revised projection, quarterly projection, indicates the faster disinflation, and inflation will return to mid-single digit level over the medium term, which will be supported by several factors, including the lagged impact of tight monetary and fiscal policies, and the expected softening of energy and food prices and their spillovers to general price level, and possible repricing of goods and services due to the appreciation of the exchange rate, plus the favorable base effect. So the headline inflation is expected to decline further and stabilize around mid-single digit level over the medium term. And in July, and this month, we expect inflation to return to single digit level, about 7% level in July, and then this will rate further in the coming months and stabilize at mid-single-digit level over the medium term. On the activity front, we expect a rebound in activity in the second half of this year. Last year, we had a contraction of 7.8%, and this year, we expect a lower contraction, which will be supported by the monetary policy normalization and the improvements in the domestic supply conditions, and the gradual relaxation of import restrictions, and overall enhancement of the business and investor sentiment. Also, there are some measures, reforms, which are being implemented, which will support, revive activity going forward. On the external front, the trade deficit has decreased notably during the first 5 months, thereby easing the balance of payments pressures to a great extent. That decrease has come from the larger compression of imports, as you can see here, while exports also have performed relatively better, but there's a larger contraction, sort of compression of import expenditure. But going forward, with the relaxation of import restrictions, we expect imports to pick up in the period ahead. And government has already announced some 286 HS codes being removed, and some further relaxations are expected soon. But we won't expect large depreciation pressures because of these relaxations, because we are expecting some further inflows to the external sector. As we are showing here, the workers' remittances and the tourism earnings will continue to improve going forward. Workers' remittances have recorded above $500 million level for consecutive 4 months, and the tourist arrivals are picking up gradually and steadily. And also, we are showing on the right-hand side some inflows to the financial account from multilateral lending agencies. We have received IMF funds over 300 million, and we have received funds from ADB over 350, same amount, and we have received World Bank funding of 250 million in July. And the remainder of the year also, we are expecting some 900 million overall inflows from multilateral lending agencies. Exchange rate continues to reflect positive market sentiments, underpinned by the improvement in liquidity in the domestic forex market. So exchange rate has appreciated so far during the year by 18.3%. And also, we've been able to absorb some sizable amount of forex from the market thus far during the year. So that reserve level remains strengthened compared to last year reserve level. So gross official reserve we estimated at 3.5 billion at end of last month. Market interest rates have adjusted downward, but there's some further space for rates to come down. As you can see here on this chart, the policy interest rate, the line below, which is 12%, and the deposit rates have come down, the blue line, but the lending rates are still high, remaining high. There is further space for lending rates to come down compared to the adjustment in the savings rate. And we have seen the government securities yields have come down sharply in the last auction as well, which is now at 13.86%, the 1-year T-bill rate. So we expect the lending rates to come down further with this adjustment. So the government securities yields have actually halved compared to the peak in November last year. The rates are now at 17.79, 15.9, and 13.86, the 3 months, 6 months, and 1 year tenors respectively. And the treasury bonds market secondary yields have come down sharply after the announcement of the domestic debt optimization. The credit has continued to contract. This is private sector credit. From June last year, month on month, credit showed a contraction. So we expect going forward some moderation of this contraction, now have some positive credit expansion on month-on-month basis with the relaxation of imports, with the relaxation of monetary stance, and the falling interest rate structure overall. So with this adjustment, the Monetary Board expects that the banking and financial sector to pass on the benefits of the reduction of policy interest rates to the businesses and individuals so that it can support economic activity going forward. If the expected pass-through of policy interest reduction is inadequate and sluggish, the central bank will consider taking administrative measures to ensure the timely and adequate pass-through of accommodative monetary policy to market interest rates. So with that, I'll end my presentation. I invite Janaka and Sudhita to continue in Sinhala and Tamil respectively. Thank you.